A subtle yet powerful transformation of the global financial system is currently underway. This profound shift is not always immediately visible, but its effects are far-reaching and undeniable. At the heart of this change, U.S. high interest rates are acting as an undeniable force of gravity. They exert a constant, magnetic pull on capital across the world. This force quietly and consistently draws global investment towards the United States. It reconfigures financial landscapes and redefines economic priorities everywhere. For nearly 2 decades, the world experienced an era of historically low interest rates. This period fostered an environment of easy borrowing and abundant capital. This pervasive cheap money fueled unprecedented growth and encouraged significant risk-taking across numerous industries. It became the foundation for many economic strategies. Industries expanded rapidly, countless startups emerged, and government spending soared, all built on the premise of readily available, inexpensive credit. This era shaped our modern economy. The Federal Reserve initiated an aggressive rate hiking cycle, marking a decisive end to the era of cheap money. This move was a direct response to persistent inflationary pressures. This action triggered a rapid and global financial realignment, sending ripples through every corner of the international market. Capital flows began to shift dramatically. Consequently, capital began flowing decisively towards the US dollar, seeking refuge and opportunity. The dollar's strength became a global benchmark. Investors, seeking both safety and attractive returns, found their ideal combination in US Treasuries. These government bonds offered stability in uncertain times. As US rates rose, emerging market currencies weakened significantly against the strengthening dollar. This made imports more expensive and debt harder to service. The debt burdens for many nations and companies, often denominated in dollars, increased dramatically. This created significant fiscal and corporate stress. Companies that had become reliant on easy credit and low borrowing costs now faced severe challenges. Their business models were suddenly unsustainable. Even within the US, regional banks experienced failures due to significant bond losses. Their long-term, low-yield assets depreciated sharply in value. Real estate markets globally saw historic losses and corrections as borrowing costs surged. The era of cheap mortgages abruptly ended. Established corporations, accustomed to refinancing at low rates, struggled with unmanageable debt loads. Their balance sheets faced unprecedented pressure. Amidst this global upheaval, the US government attracted substantial international investment. Its debt became a highly sought-after asset. The US dollar strengthened considerably, reinforcing its status as the world's primary reserve currency. This provided a buffer against global instability. Countries around the globe increased their dollar reserves, further solidifying the dollar's dominance. Global funds shifted their allocations, moving significant capital towards American assets. The US became a magnet for international wealth. In this new landscape, companies are pausing new investment plans, adopting a wait-and-see approach. The cost of capital has become a major deterrent. Families are postponing major purchases, such as homes and vehicles, due to higher borrowing costs. Consumer confidence is directly impacted. Governments are revising their budgets and spending plans, grappling with increased debt servicing costs. Fiscal prudence is now a necessity. Widespread uncertainty exists regarding the duration of these high rates. Businesses and individuals alike are questioning the future economic trajectory. The critical question now is how much rates can fall without destabilizing the economy. Policymakers face a delicate balancing act. The era of ultra-low interest rates is unlikely to return in the foreseeable future. The global economic paradigm has fundamentally shifted. Several factors contribute to the persistence of higher rates. Sticky inflation remains a significant concern for central banks worldwide. Volatility in energy markets continues to exert upward pressure on prices. Geopolitical events frequently disrupt global supply chains. Geopolitical shifts are impacting supply chains and trade relationships, adding to inflationary pressures. Economic nationalism is on the rise. Ongoing government deficits in many major economies necessitate higher borrowing. This demand for capital keeps rates elevated, This period marks a financial natural selection for businesses. Only the most resilient and adaptable will thrive. Companies that were overly reliant on cheap borrowing will struggle or disappear. Their unsustainable models are now exposed. Conversely, businesses generating actual cash flow and demonstrating genuine profitability will thrive. Efficiency and sound fundamentals are paramount. This profound shift affects nearly every aspect of everyday life. It influences food prices, credit costs, investment strategies, and job opportunities. New winners are emerging in this transformed landscape. Adaptability and innovation are proving to be key differentiators. Tech companies that can adapt to lean operations and prioritize profitability are finding new success. The focus has shifted from growth at all costs. Energy, infrastructure, and commodities are regaining significant relevance. These sectors provide essential services and resources. Fixed income markets are experiencing a boom in demand, offering attractive returns after years of stagnation. Bonds are back in vogue. Investors are increasingly prioritizing predictability over speculative ideas. Sound fundamentals and stable returns are now highly valued. Understanding the underlying market structure is crucial for navigating this transition. A deep comprehension of economic forces is essential. Recognizing incentives and adapting to these fundamental changes in capital flow is key. Proactive adjustments are more effective than reactive measures. This shift presents significant opportunities for new business models and industries. Innovation will be driven by new economic realities. New market leaders will emerge by adapting faster and more intelligently to these evolving conditions. Agility is a competitive advantage. The consequences of this global financial reorganization will define the economic landscape for the next decade. We are witnessing a historic turning point. In the next video, we are going to see a new intriguing history of the global markets. Hope to see you soon.